check on the markets and, just look at, one, what the index has done, two, what separate components are doing. So, Ranbaxy up 7.5% in trade. Wockhardt is still doing well. Aurobindo probably has a day of consolidation. But pharma has clearly been the buzzword the last 2 or 3 sessions. It's been stunning gains for some of these stocks. Massive moves that we've seen all through this week. So, on the contrast, if you have the PSUs which haven't done well, there is this whole set of pharma names which have done exceptionally well in the session today. We were talking about IT and pharma doing well. I think pharma has taken the cake this week at least. So lots of gains. And I think this is something that we'll focus on later on in the show as well. May not be showing today the BSE Pharma Index, but otherwise some stunning gains that have come in for the pharma space at large.
Yep, and when it comes to the macros also, there's quite a bit of movement that you're seeing, especially with the bond yields as those fears of hardening above 9% now seem to be coming about. You've got the rupee, which is currently at 60.32, in line with what the rest of the emerging market currencies are doing. So let's get into a discussion with Maithili Bhushan, consulting editor ET Now, and in a short while, Shubhda Rao, chief economist at Yes Bank, will also be joining in. To start off with, Maithili, run us through the trajectory that you're penciling in now for the bond yields.
Well, it does seem as if the bond yields will go up, and 9%, between 9 and 9.25, I think would be my estimate, because clearly the RBI is not very confident on either growth recovering or inflation really trending down. If you read both the macroeconomic development statement issued along with the review, the bi-monthly review, as also the governor's own statement, it clearly shows that the RBI is fairly apprehensive. So I think till such time as we get some clarity on the political front, you will find this kind of movement on the yield front. So I think we have to be prepared for that interest rates are likely to go up, and particularly what does it mean in terms of growth? If it means that growth is not going to pick up, then we might find forex inflows also slowing down. So overall, the sentiment would be one of uncertainty with an underlying bias towards a hardening of yields.
Maithili, just before we focus more on the macro, just a word really, I wanted to ask this to you on the bank licenses, and we've spoken about this umpteen number of times. I'm sure you're happy that the EC gave the go-ahead and a couple of companies have got. But do you think that the number was very restrictive and a lot of others which were prime candidates would have been left a bit disappointed?
Well, doubtless those who tried, applied and didn't get are bound to be disappointed. But the number is very much in keeping with the RBI's traditional conservative view, and it's not such a bad number to start with, given the fact that it's happened at such a time when there was so much controversy. And though the Reserve Bank of India did take the precaution of referring it to the EC, the fact remains that had they in fact given it to a corporate, all hell might have broken loose. One doesn't know, because then the other corporates would perhaps protest, etc., etc. So I think the Reserve Bank has played it safe by giving it to those, just one or two, limiting it, at the same time saying that the licenses will be available at any point of time, provided the promoter group satisfies the fit and proper, has the necessary financial wherewithal, and everything else that the RBI had laid down in its guidelines is satisfied. So those who haven't got licenses now needn't think that this is the end of the day for them. They can still apply sometime later, and I would a sense that the RBI would periodically give licenses, maybe not once in 10 years, maybe more frequently. So I don't think it's really the end of the road for those who applied and didn't get licenses.
Okay, that's an interesting view, but let's also get in Shubhda Rao, chief economist at Yes Bank, because there's so much to really talk about, and it's the currency that I'd like to touch upon, because clearly the outcome of the election, that sentiment seems to be taking the equity as well as the currency markets into top gear. But what happens post the election outcome?
I would think that it's a combination, no doubt, that we have seen significant inflows on equity as well as on debt over the last few months. Couple of months, and more recently in few weeks, I would think that inflows have seriously supported the currency, which actually tested below 60 for a day or two. I think a part of it was also seasonal. Let's not take that factor away. Typically in the last quarter, you do see some of these inflows coming in, and that's exactly what we saw. That coupled with improving macros, and when I say improving macros,
okay, improving macro. Shubhda was just giving that view in response to Avan's question. Excuse me. I think we'll just get across to Shubhda in just a bit. But Maithili, essentially the same question to you. And while all cues have gone off the radar now, we don't have too many other cues. But what do you make of the situation currently in the macro front?
Well, it's very, when you're talking about forex trends, which is what you are asking Subhda about, I think it really defies all logic, because macroeconomics seems to have broken down. All the fundamental rules seem to have changed, because here is the US tapering and there is the S&P also running up, emerging markets also doing well. So it really, one doesn't have an explanation really, because if one said that yes, because the US is ceasing its tapering, the US dollar is looking a safe haven, so funds are going back from emerging markets, then it makes sense that the S&P should rise. But how is it that the S&P also rises, emerging markets, stock markets also do well? So frankly, Neeraj, I think one has to go back and try and look for new explanations, because the world is changing completely. I don't know whether it's a brave new world or a foolish new world. I can't say anything either way, but certainly it's an entirely new world, and maybe we'll have to rethink a lot of our fundamental macroeconomic principles.
Yeah, I think we'll have to do that, and that's putting it succinctly. I think there's a lot more to this as well. And Shubhda, you just heard, you were just giving your reply as well, and Maithili added her 2 bits out here as well. But let me ask you to finish your point first.
Yeah. As I said, rupee strength over the last few years. We have seen very limited volatility over the last few months in rupee, particularly, since the beginning of the calendar year. Now that is more, getting a grip on our macros. Our macros were, deteriorating. We got a grip on our current account deficit. We got a grip on the funding risk of that current account deficit. So current account deficit, which was being envisaged over 4.5% of GDP, is now likely to be at 2% of GDP. More importantly, because of the extraordinary measures taken, the funding risks have also abated significantly. That began to have a salutary impact on currency. Second and more important point is single-minded focus of the central bank to tackle inflation. Yes, inflation still remains beyond comfort, but the fact is, from 11 quarter or 1140, as we saw peaking, it has corrected to 8.1. That has not escaped the investors' attention, that there is a strong message from the central bank that they want to, so to speak, attack inflation and make sure that inflation expectations don't get entrenched. That, to my mind, is a signal of improving macro. We are looking on any dramatic improvement. But definitely we have gone past the bottommost point of the economy. So we have improved external sector scenario. We have a better handle of inflation management.
Okay, I'm afraid we're having a bit of a problem with that. We'll get just right back to Shubhda, but in the meantime, we've been talking about how there have been, the HSBC Emerging Market Index in terms of the reading. That once again came in lower, and the output has also fallen in China, India, Russia as well. Maithili, run us through, what exactly you make of this. And, we've been talking so much about how this in the overall scheme of things also isn't fairly positive.
Well, it's rather worrisome, because the HSBC PMI, both for services as well as for manufacturing, is showing a decline in March. And for services, it's the 9th month where we are seeing it slipping. And services, mind you, is what has been propping up the economy all along. Manufacturing industry was anyway in a very bad shape. So if this is a situation, then quite possibly the 4th quarter, on which we were hoping to see a revival. And remember, we were hoping to get to 5.5%, and that was the only way we could achieve that 4.9% for the year as a whole. So the 4th quarter does not show any revival. And we have growth coming in the 4th quarter at less than 5%. That means the year as a whole will get somewhere between 4.5, 4.6. And that would be really quite disastrous. Whatever improvement we do on our macroeconomic front, Subhda was talking about the current account deficit in terms of inflation. I don't think any investor will be very happy to invest in an economy which seems to be stuck at sub 5% growth. So to my mind, the HSBC numbers are really, really quite disconcerting.
Maithili, there's so much talk with respect to what's happening on the global front, and, yesterday also we discussed that perhaps just the talks of the Fed taper have been more detrimental than the actual taper itself. So run us through, how do you expect, the global ramifications to impact emerging markets, particularly India?
Well, so far it's really been pretty good all around, because I think the fear was much greater than when the event actually happened. Because if you remember, in May, there was this talk that the Fed might taper. Everybody in India really took fright. Foreign investors took fright. And finally, when the taper did begin, things were not so bad. So by and large, emerging markets have, I think, handled it fairly well. Also, you must remember that expectations were also quite low. Everybody thought that, all hell would break loose. So the very fact that by and large, emerging markets have managed okay does seem much better in comparison to the fear. So I think the fact that the Fed has been fairly nuanced, that it's been going slow, and if you read Janet Yellen's statements, she's been very emphatic that even if the unemployment number is reached, the target that they have of 6.5%, the Fed will still keep interest rates low for a long time to come, till they're confident that US recovery is happening. And mind you, when the taper actually completely goes through, if the US economy recovers, then we will see global demand for emerging market, products, exports, etc. to pick up. We'll find more willingness to take risks. So one will be offset by the other. In the short term, there will be pain, but not as much as everybody feared. So I think overall the world has got through pretty okay. But I'd still keep my fingers crossed, because one hasn't seen. This is just the beginning. We've only had 3 rounds so far. There still is some more to go. And 6 months after the Fed taper ends, she's also said there is a possibility of US interest rates looking up. Now, if that happens, one will have to see how emerging market flows react. But so far, so good is what I would say.
And Shubhda is back with us. Shubhda, this morning we were also talking with Montek Singh Ahluwalia, who said that India's growth rate is well below its potential. Do you think that we can revisit those levels of 5.5% to 6% for 2014-15?
Yeah, as I was saying, that while the fiscal year gone by, we anticipate growth would have probably touched at best at 4.7. We are not likely to see a very dramatic improvement, because investment revival is yet to be seen, in a meaningful manner. We do have small incremental improvements here and there, but nothing very comprehensive or broad-based. Given that, and given a little bit of improvement, I reiterate, I do believe that there is a little bit of improvement in the economy than what we saw in the first 3 quarters of the last fiscal year, or even into the entire 4 quarters of last fiscal year. We do see some traction taking place, and we are ourselves anticipating about a 5.3 to 5.4. Nothing dramatic, mind you, but a lot rides on the election outcome, the turnaround in the sentiment, particularly for the investment, which, if the government really steps up and improves its act, then it could possibly manifest in the second half of the current fiscal year, not before that. So growth would be, tentative, tepid recovery, no two ways about it. So I would still believe that it is still going to do a bit better. A potential, no doubt, as I said, because of the investment not having really picked up in any meaningful manner, has resulted in our potential output going somewhere close to our own estimate is 5.9, and we are growing still below potential. But I don't think, given the kind of absence of meaningful recovery in investment, that there is such a huge gap between the actual output and the potential output as we go into the current fiscal year. It could be about 50-60 basis points. So if any small recovery, it would continue to have some upside risks on inflation, no doubt about it. It's going to be a there are many upside risks, in fact, to inflation. So RBI, therefore, has been pat on being vigilant about it. Would see a lot of change of stance, or review of stance rather, post the new government's budget presentation. I think till that time, the bond markets over the last couple of days have reacted to 2 or 3 things post monetary policy. One, that if you look at the effective cost of borrowing in the money markets, it has gone up by about 25 basis points, because the focus has shifted from LAF to more on the term
and ask
repo. And as such, a large part of borrowing.
Subhda, if I could just interrupt you and ask you, you pointed to 2 silver linings in the macro situation. One is the current account deficit and inflation. Both of them definitely have come down as compared to the highs. But is the improvement sustainable on either of these 2 fronts? So are they very transient silver linings?
To an extent, they're transient, Michael, because yes, we cannot live with a 10% gold import duty, perhaps. As and when the situation improves, we will see a hike, or rather reduction in gold import duty. To that extent, the demand for gold would rise. But on the positive side, Maithili, if I were to look at the diesel price correction, since the time it began, diesel prices have been revised cumulative basis at least 14 to 15 bucks. And if you see the volume of diesel demand, it has come off since last 2 quarters. So somewhere there is a small little structural component getting into the realistic pricing of fuel products, and therefore oil demand, to the extent it is elastic, getting corrected. I'm not saying that we have achieved everything. We saw the distortions on our trade account purely related to commodities. Iron ore not being allowed to export it, coal demand rising dramatically because of the mining issues. So yes, those issues definitely need to get resolved. But I'm just saying that, is the policy maker going to be so naive that he will just allow the trade deficit numbers to go out of hand unless and until he has confidence that some improvement is happening on the environment clearances, on the mining policies, and therefore the coal demand begins to adjust somewhat on a realistic note in tandem with what the economic activity domestically is going to play out. So I think definitely no debate there that these are transient measures. But the fact is, if you need emergency measures, so be it. I think it's commendable that the current account deficit corrects by 2.5%. It's not a mean feat.
Right.
Other emerging market economies are trying to get a grip on it. They have not been able to. We have been. And, let's give them some credit. Yes, it's a stopgap arrangement. It's a short-term adjustment. And we should not be resting on those laurels. But the fact is, those numbers have been achieved. No two ways about it. And, that is the confidence that probably they have, that there is the will to resolve matters and the confidence to manage inflation. Once again, I go to that.
Right.
That yes, inflation is high, but the investors are now beginning to feel slightly more confident on the policy making. That policymakers are slightly more, I would say more resolved in their manner that they need to get inflation under hand. I think all this is changing the sentiment at the periphery. A lot of work needs to get done, no doubt about it.
Right.
We cannot be happy about the situation, that this is going to be without any hard work yet to be done.